Most advisors do this wrong. In this episode, I'm going to address the question, what are the rules for doing a 1035 exchange of life insurance? And I'm going to tell you a story that just recently happened in the last few days with a client that came to us seeking a 1035 exchange, and he didn't know what he didn't know, and he was pretty sharp. Neither did his other advisors understand what I'm going to teach you next. So why is it that most financial advisors do this wrong, a 1035 exchange? So let's start with the basics, and I want to share a story with you that just happened with a client that came to us that was very frustrated because his financial advisors did not have a clue what they were doing when he was considering a 1035 exchange. And he had been watching other educational YouTube videos, and he knew his policy was way underperforming. So I'm Doug Andrew. I've been a financial strategist, a tax minimization specialist for more than 46 years. And this particular gentleman is pretty sharp. He's made a lot of his wealth in real estate. And he'd been watching and listening to a lot of my educational videos, and he had an insurance policy that he had set up 15 years ago. Now, as soon as he gave me his numbers, I knew it was not structured to perform as a living benefit. That's what he did it for. How did I know that? First of all, he's in his early 60s. He's a little bit younger than me. And he said that the death benefit was $4.5 million, and he had $1.4 million of cash value, and he said, it's draining. The costs are eating it up. And I went, okay. Now, at his age, I knew if he had had that policy for 15 years, had it been structured correctly, that if the death benefit was $4.5 million, he could have had maybe $5 to $10 million of cash value in there by now, or he didn't need $4.5 million of life insurance at the beginning. I didn't know what the objective was back then, but when he said it was to accumulate money, then he could have gotten away. If he has $1.4 million of cash value, he put, I think, $1 million into it. The minimum death benefit would have been maybe $3 million, not $4.5 million. You say, well, what's the difference? All the difference in the world. It's the difference between earning maybe 10% and netting 9%. Instead, he's been earning maybe 7 or 8 and only netting 4 or less. The cost of the insurance is gobbling up most of it, and now that he's getting older, it's becoming more expensive. When I structure my indexed universal life insurance policies, they get cheaper as I get older. After 15 years, my cash exceeds the death benefit. If I start out with $1 million, at age 60, I put in $1 million, the death benefit under the IRS tax citations, TEFRA and DEFRA, say I'm supposed to have $2.5 million of insurance, not $4.5 or $5 million. And by the time 10 years has gone by, if I put in $1 million, it would have doubled to $2 million. If I have a death benefit of $2.5 million under TEFRA and DEFRA, now $2 million of the $2.5 million is my own money. The insurance is getting cheaper. By the 15th year, my cash value is greater than the death benefit. His wasn't even close to that. So I knew immediately this was not designed to be a living benefit policy like maybe you thought it was. He recognized that after watching and listening to educational videos and hearing me talk about how to do this right. So he wanted to do an exchange. He wanted to update. He wanted a comparison, but he basically knew that he needed to exchange his old, outdated, not structured correctly policy to a new one so that he could maybe add additional money to it. And he could generate the income that I've talked about between he and his spouse's policy that they could have in a short time period of maybe 10 years, $3 million generating $300,000 a year of tax-free income because keeping the old one just wasn't cutting it. So He was so grateful to understand how to do this. So let me share with you how we had to analyze it with an in-force illustration. If an agent is trying to get you to swap out, replace an old policy and doesn't order an in-force illustration and analyze it, that's a red flag. We want to see absolutely how much room is in there to maximum fund it. And does it make sense? And when's the break-even point? And so we have to have all those details to know how to accurately give advice on whether it's wise to do a 1035 exchange and keep it tax-free. So let me explain what I just said. We have to analyze that most agents have no clue how to do. So when we met, we needed to get a minimum of 5 critical numbers out of his existing policy to find out, okay, how was it designed? How much room could you have put into it? And it was obvious he had not maximum funded it. Whoever sold it to him sold him more insurance than he needed. And he claimed it wasn't about the death benefit per se, it was more about the living benefits. But there's amount of room that he didn't use. See, under the TAMRA tax citation, you can put in a maximum amount under TEFRA and DEFRA, but you can only put it in over a period of 5 years. Well, he's had that policy 15 years. So he's way past the 5-year period, but we realized that he could have put in a substantial amount of more money into the policy and it would have performed better. He said, well, I didn't intend to put more money into it. I thought it would just zing along. Not the way this was structured. So now he wants to add new money. If he cancels that policy, and he knew this, if he cancels it and takes the money, any gain he would have had would have been taxable. It was actually depleting, but we want to use a 1035 nonetheless, not to save on tax so much as to optimize what we're going to grandfather and transfer over into a new policy. So let's say that he put in $1 million, which he did. But with a $4.5 million death benefit, he could have put in another $500,000, maybe $2 million instead of $1 million. Now, he didn't do it. Maybe he wants to do that in a new one. We go, no. If you can put in that $1 million into the old one first, why would I do that? Because when you put it in the old one, you've maximum funded it. You've jumped through those hoops. And now you have $2 million. You immediately do a 1035 tax-free exchange into the new one. He doesn't touch the money. It goes from his existing insurance company to a new one. And it hits the ground running. And now he has $2 million because he was grandfathered because he maximum funded the old one. If he had not done that, he would have had his new $1 million go in and he would have had to spread that out over 5 years maybe before he could access the money tax-free. Here, he can put it in and it's all grandfathered right off the bat. That is a consideration that is so critical. He got it and he realized that no other advisor had ever told him that he could actually maximum fund the old one, then do a 1035 tax-free exchange into the new one and hit the ground running instead of having to wait 5 years perhaps before the new one is funded in compliance because it was already complied with through the old one. And by doing that, he can hit his goals now instead of waiting 5 years to do it. He was thrilled with that information. So let me connect the dots. Now, one last consideration. You don't want to ever do a 1035 exchange tax-free until you've had an audit, an analysis, a comparison, a review by a professional to do that. And I point my students to those who know how to do that. You get an in-force illustration, you analyze what the objectives, the goals are, and then you make sure, do you want to use the room you didn't use in the old one? Maximum fund that and then immediately transfer it to the new policy. And then you don't have to have that waiting period, the 5-year funding period under TAMRA for those new dollars if they can fit in the old one before you transfer the money. But last of all, don't ever do a 1035 unless you have the new policy approved in place, ready to accept it. In fact, you can't because you notify the old insurance company, I'm doing a 1035, and they have to send the money directly to the new one. The new one has to be approved and ready to go, okay? And so it's usually good to at least put in a minimum premium to have the policy ready to accept it, because sometimes 1035s may take several weeks before the old insurance company sends the money over to the new one, because they don't like to say bye-bye to money. And so they will take their sweet time sometimes to put it over, but generally it happens within a few weeks or within a month or two when you do a 1035 exchange. Now, if this arouses curiosity and you want to learn why many people do 1035 exchanges into indexed universal life, like instruments, okay, life insurance for a different new kind of life insurance, not an annuity to life insurance. You can't do that. They want to learn about this, and that's why I wrote this book, The Laser Fund. This is my 11th book. It retails for $20, but this isn't about selling you a book. I want to gift you a copy of this 300-page book for free. You just simply pay $5.95 shipping and handling. How do you claim your free copy? Go to laserfund.com, L-A-S-E-R fund.com. Pay the $5.95 shipping and handling, and I'll send out the book to you absolutely free of charge for the book. And you'll also have options for the audio version and other video training. If this intrigues you, you'll have all kinds of charts and graphs and explanations, and there's actually 62 actual client stories in this book. So enjoy, educate yourself, and consider if maybe having an audit on your life insurance is worth your while, so that you can have the new, improved, updated version helping you to achieve a greater retirement.